Welcome to the Dividend Talk podcast, episode number 30. 4 interesting upcoming European dividend announcements. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you are new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hey everyone, welcome back to another episode. I'm here with a beer in hand, chatting to European DJI as usual. How are you doing, man?
Really good. New year has started, work has started. It was my least productive week, I think, this year, and it will be this year. But it was also really nice. Not too many meetings, just a bit on my own, thinking about what I want to do this year. So yeah, had a good week.
Yeah, you deserve that. You are fairly busy over the Christmas period, writing blogs and posting videos. So you needed a week just to ease back into things.
But to be honest, for me that's relaxing, blogging and such, because it's like for others reading a book or sporting. For me, it's relaxing because it's I love thinking about dividends and dividend companies. So actually, I don't get tired from that. I get more tired from kids banging their heads with each other.
Oh yes, I know that feeling too well. So, what's going on? Any news that you've been following this week or keeping up to date with?
Yeah, well, I just a little bit about the craziness of stock market again. So Chamat, my favorite investor, announced yesterday that they will do a SPAC merger with Sophie for ticker symbol IPOE, and boom, 80% up or something like this. And this guy is turning everything into gold at the moment. It sounds almost too good to be true, and often that's a bad sign. But in this case, I just think that this guy is just a brilliant investor. I've seen many videos from him. I studied him a few months back, and lots of interviews. And this guy has a whole team that's just analyzing which industries are currently broken and where technology might be able to disrupt. So even yesterday, he was talking about the energy industry, about all the utilities. So he's really thinking about attacking the utilities. I don't know how he's going to do that, but he has a whole team of clever guys trying to figure out how they can find the company that's best set up to disrupt an industry. Amazing.
Yeah, he's a bit of a genius. Everything he seems to touch is just, as you said, turned to gold. He's like a modern day Warren Buffett in the making. He's just, I haven't studied him as well. If you have, it's only recently, but I mean, these IPOs are just a gold mine for him, an absolute gold mine. And sometimes I wish I could get in before they go public, because that's where you make your money, isn't it? But I don't know.
But this is actually what he's doing, right? So that's why he makes these specs. So he usually issues them for $10 a piece, so that actually, how is it? Retail investors can buy it without the company being known yet that they will merge with, so that we get also an edge. And what I also want to mention is he became famous more because of Facebook, but not so much because of that. He entered the media also with his predictions about Bitcoin. So he was literally mentioning that Bitcoin will go to $100,000, and people were laughing at him a few years ago. Yeah, so that was that's where he earned a lot of money, and now the specs, and you just see his career growing from a Bitcoin gold rush guy to a tech investor. And he is even mentioning that Buffett is his big example.
Yeah. One to watch and keep an eye and see what kind of moves he's making.
Definitely. What's your news from the week?
Oh, this week I caught up with Walgreens. You know, I'm a big fan of Walgreens. They released their earnings. I actually didn't expect it so soon, but they released it 2 days ago. Or I caught up on it last night. I was actually quite impressed with it. Their sales have been up free cash flow is up 13%. The UK boots in the UK, their online is really performing well. I think the sales doubled from this time last year, which is quite impressive. They've what have they else have done? Oh, they're divesting their pharmacy, so they're selling that to a company called Army Source Bergen, who they also hold a 30% stake in. So they're selling that company to them for 6.5 billion, but they still have a stake in them, so they'll still benefit in the profits. And they're also accelerating their investment in Village MD. So they've invested about 1 billion already. I can imagine that they'll take some of that money from the divestment of the pharma wholesale and speed that up. So there was a lot of news to take in, a lot of positive. Their share price went up maybe 6-7%. So it was quite positive, and I'm looking forward to see how they do this year. And I did mention that next quarter they are expecting a massive hit from COVID. You could see a small hit on this. One thing that did vex me a little bit, and I know I spoke to you, was on their income statement there was a loss of nearly 1.5 billion equity loss, because I couldn't get my head around how that works. But other than that, they look quite strong, and I'm quite happy with how they went.
Well, kudos to you so far, because I remember one show here in Dividend Talk where you were talking about Walgreens and where you were talking about the online capabilities from them and such, and that this might be a boom for the upcoming period. So, yeah, well spotted.
Yeah, I think COVID has helped speed that up a little bit. I mean the retail earnings in the UK are certainly down. Boots would typically be a shop on the high streets, so you'd have millions of people walking past and just popping in. They don't have that anymore. But online, just like Amazon or just like everywhere else, is starting to take off. I mean, from an Irish perspective, we've been hit massively now by Brexit. So typically, if we're buying stuff from Boots, if it's coming from the UK, we'd have it the next day, or there'd be no issues. We can't order stuff from Amazon from the UK anymore. The postal services have stopped because there's now custom charges up to 70%. There's so much uncertainty that we actually can't order from online. So I don't know how that's going to impact us over here. But from a UK perspective and a general European perspective, it's looking strong. Okay, so our main topic today, we're going to have a little bit of speculation, something that we don't usually do. So we're going to take four European companies, and we're just going to talk about their upcoming dividend announcements and maybe predict and see if we can predict what kind of increase they're going, or if they're even going to increase. So I'm going to let you go first. You're the master of European companies. It's the name of your blog, after all. So I'll let you have the first pick.
Okay, so I'm going to pick a company that's going to announce their annual reports on the 25th of February. So I know it's a little bit out still, but I think it's really interesting to share it now, because it also allows listeners to do their own homework on time, because we all know it takes typically a few weeks to really understand the company. So Bayer is going to announce on 25 February. And in the last 3 years, they paid a dividend of €2.80, and the current yield is around 5.4%. This is a really juicy yield for a European company, and specifically in the world we live in now, with many companies on having a low yield. What you need to know about it is that this company has been severely punished for the Monsanto acquisition. I think a few years ago it was trading around €100. Now it's trading around about €50, so half the share price. And with that, they also increased a lot of debt. I call it the worst acquisition in modern history from a European company. It's really insane what they have done. I also think their board of directors needs to be fired, and they need to be literally all their money claimed back. But that's my personal opinion there. What I would like to say is that if we look at their core earnings that they report they had like €6.30 per share in 2019, and over the last 9 months they had €5 per share. You need to know that they took all the one-off litigation expenses and everything out of it. So, but what caught my attention in the end of September was that the payouts in the upcoming years are expected at lower end of the 30-40% range, so 30%. So I think, therefore, that we will see a dividend cut of around 25% on Bayer. I think they will cut their dividend to around €2, €2.10 from the €2.80 where it is now. So my prediction is a dividend cut, actually. So it's a nice opener for this show.
I've been following you quite a bit on Bayer, and it was interesting to follow your progression. And you had a lot of patience at the start, and now your patience seems to be just gone with the board of management in particular. Will the dividend cut be enough for you to finally cut your losses with this company?
No, because I'm not emotional in my investing decision. I've switched it already in my mind from a dividend company to an undervalued stock. So I think the company is heavily undervalued. Their cash flows are strong enough to cover the debt and such. So I think any good news around the settlements, around the Roundup case, might actually give a nice pop in the share price. If it goes back to 100, I will sell it, because then it's for me the fair value is around 80 or something like that. So if it comes to fair value, I will sell it. But it's not anymore a dividend stock for me that I want in my portfolio in the next 20, 30 years.
Okay.
Unless they keep the dividend and promise that they are so committed to it and do a miracle.
Yeah, but looking at that payout ratio now, it's over 60%. That's quite high for a European company, isn't it? So you could definitely see them reducing that down and cutting that. I'd agree.
Definitely.
Nice.
What is the company you would choose?
So the first company I would choose is L'Oreal, and really because I'm worth it. That's pretty much the only reason. It's actually quite an interesting story with them. Last year they announced an increase for 10%, and then they cancelled it. Obviously with COVID coming up and the uncertainty, and that's not too uncommon with European companies. I've seen Smurfit Kappa do the same, and then they've reinstated it once they knew. So based on that, we know they wanted to increase the dividend, but the uncertainty at the time, they just weren't sure if they could or whether it's the best thing to do for the company. So they said, "Look, hold on, we'll lay it off and see." So based on that, I think they may increase it this year. A little bit of the uncertainty is gone. If you look at some of their figures, the revenue has increased slightly. The trailing 12 months is down. Obviously, we expect a little bit, and the earnings per share is down as well. But the dividend seems to be well covered there. There was one interesting thing as well that came up, and I never knew this with some French companies, is that they offer a loyalty bonus of, if you invest with them for 2 years, I think it's about 10%. So if you're with L'Oreal and you have shares in them, you get 10% additional, which is quite a lot, and it adds up to your yield pretty quickly. So for me, my prediction is, I don't know if they'll go to full 10% like they did last year. I'd say they might be a little bit more conservative, and I'd say maybe 3 to 5%, but we'll see. Yes, that's pretty much my thoughts on L'Oreal. I'm thinking that they will increase. They have a great history, I think, from 1963. So I'm hoping they will continue that trend. So yeah, on to your second company.
Cool. So my second company is Philips. Philips will announce their dividends on the 25th of January. They currently trade around €45.5, and they yield 1.9%. So it's not a high yielder, but I analyzed this company not too long ago. And what I found really interesting is that they really did a turnaround. Yes, so they sold their light bulbs division, not anymore producing TVs, just licensing it. And what I noticed there is that they're at the beginning of a turnaround. The turnaround is young. It's like 1 to 2 years, but I think they have a lot of growth ahead of them now as a tech medical company. So what you need to know is that their dividends grew over the last decade, not even 2% compounded annual growth rates. Last year, they grew their dividend from 80 cents to 85 cents. And I actually think that this was the start of proper dividend growth again for the upcoming years. If I also look at their revenue growth, it's okay, but the nice thing is that you can really see in the numbers also a bit of a turnaround starting. COVID has hit the company because, for instance, it was harder to supply some medical devices because everyone is now thinking about COVID. They had this issue with the American government about their devices supply as well. So maybe even they would decide then to freeze the dividend just for this year to weather out the earnings. But I really think that there's a new summer coming up for Philips. So I'm really, really much looking forward for what they will announce at their dividend. I'm hoping, but this is more hope, for 90 cents per share. That if I would need to bet, I will bet on that. And this would be rather for them, not because of having all the earnings easily or better than last year, but rather more like a confidence statement.
Yeah, they remind me a lot of Siemens in many ways, in how they're transforming the company to that tech health space. I always associate Philips with, I don't know, toothbrushes, electric toothbrushes and TVs. So it'll be interesting to see him change direction and move more into that space. It's not a company I'm overly familiar with anymore. As I said, I always thought the TV was the main thing. So it'll be interesting to see how they actually make this change and if it works for them. And it's definitely going to be a company like Siemens that I might look into a little bit more.
Yeah, I find them a little bit on the high end in the value. And to your point about toothbrushes, they intend to sell the those device division as well. So no more shaving with Philips and toothbrushes. Probably the name will stay, the licensing again, but they don't want to own it anymore, these assets.
Yeah. Okay. Cool.
So what's your company?
Yeah, so the last company of the day, I'm going to pick Ahold Delhaize. I don't know if I pronounced that right. You can correct me. But they are a company that they're considered up there with Amazon in Europe. They're quite a large company. They have their own online company. I think it's called Bol.com. It's BOL.com. Yeah. So they like to call them the Dutch Amazon. I don't know why I'm speaking about these. Actually, you know these way better than I will. But they merged with Delhaize, I believe, which was a Belgian company a few years back. Which is why they have their name Ahold Delhaize. And their last hike was around 8%, 8-9%, which brings our yield up to about 3.3%. So they have a strong payment history in dividends. What was interesting is in 2019 they had their final dividend of 46 cents, and their interim dividend in 2020 was 50 cents. Usually you don't see the interim dividend higher than the final dividend, so that was quite interesting. So predicting what their next dividend will be, I think we'll certainly see a hike. I can't see them being lower than what they've done before. So if they were to do it, say 50 cents, they would go from a final dividend of 76 cents up to €1. So that's a 10% increase, and it still gives them lots of room to grow their dividend over the next few years. So yeah, I expect them to increase. They've been aggressively buying back their shares as well over the last 2 years. I think 11% over the 2-year period, which is quite strong, and again adding to your share price. And what I actually like about them is the revenue has been quite strong. And if you look from 2015 and 16 to 2017, there's a huge jump, but that's because of the merger, I believe, with Delhaize. But then even after that merger, it's went from 62 billion to 66 billion in 2018, 2019, and the trailing 12 month is 72 billion. So the revenue is quite strong. The gross margin is up around 27. Earnings per share has been growing. I think the trailing 12 months is now 181, which was 160 last year. So I can see them increasing that. And again, the payout ratio is around 50%. So there's plenty of room for them to keep growing that dividend.
Yeah, so it's really funny also for you to hear you talking about Ahold. But I'm impressed. What I want to say is, like, for me, Ahold, if you look at this dividend growth rate also of 10% over the last decade almost, right? This company is on fire when you think of a shareholder return. And I know they are also buying back a lot of shares, but they can easily do it. That's the thing, right? A company with a strong balance sheet. I mean, it's amazing. It's amazing. For me, this is like one of those diamonds currently in the European stock market. Out.
Yeah, and they're buying them back when they're relatively cheap as well. They're not an expensive company. I have been actually selling puts on these for the last while. I'm being a little bit greedy. I probably would buy them at the valuation, but I'm selling puts at around €21, and see how that goes. See if I get hit. But at the minute, I'm just collecting premiums on them.
Super. Yeah, I hope it to be anytime soon. Hopefully this quarter to be a top 5 position. So
oh wow,
if
okay.
if I get impatient, I'll just buy some.
Cool. So that's our fun for today. We've done a little bit of speculation. So we had 1 dividend cut and 3 increases. So we'll see how that plays out over the coming quarter.
Good. So let's go then to the next section for us, the listener questions. And well, how could we not start with a question from Phil? It's almost like a tradition, and we know he broke it last week, right?
He broke it last week, so I was expecting 2 questions. Honestly, I was expecting 2 here, but we'll forgive him.
Yeah. So, question to you: which investor skill do you want to improve in 2021?
Yeah, for me, it's understanding the financial documents. I think I have a good top level understanding now, and it's just getting into the finer details. Like I was saying with Walgreens, getting into, I mean, seeing these charges on the income statement for equity and equity loss. What does that mean? How does it relate to the balance sheet and the cash flow statement and so on? So that's my real focus, is to get a deeper understanding. I'll do that by writing on my blog. I'll be writing analysis, and the more I learn, the more I'll write about it, and the more I include. So you'll see my progression as I go along this year. How about you?
So what I took away from 2020 was that I made really good steps in diversification, but at the same time, it meant also that I was looking into many companies at the same time. And this year I want a bit more focus. So I probably want to spend 4 or 5 companies really aggressively on in this year, but those really that also provide a good value. So for me, it's focus just.
Okay, good. Okay, the next question then is from Kaylin, and he asked, what do you think of SAP, and is it currently undervalued? And I'll hand this over to you because I know you wrote a post about him recently. So
yeah, so what's probably good to know, why are people looking at SAP is because of the share price drop, right? It went quite down, but it went rightly so quite down. SAP is just missing out on a lot of the cloud transition. The only good thing here is that SAP has a really, really huge, lock-in. And I know some companies where people work within my network that are still making multi-million-dollar investments in SAP, and it's not maintenance, operational investments. These are really CapEx. So it still shows that they have an edge there, but it's not out of strength. I think it's more out of the lock-in. So for me, I think this company is still like heavily overvalued, and I will not touch it before it is in the 70s, preferably the low 70s. It might never get there, but if I look at the current metrics, I find SAP really not attractive. And yeah.
Okay, cool. So our next question is from Rick Lan, I think it is. And he just asked us, have we any purchases this side of 2021 yet?
I can start with a sale, actually.
Oh.
I sold my Philip Morris. I had Philip Morris already for 6 years in my portfolio. And then my wife was reading my annual report, and she saw a picture there, a graph with Philip Morris in it, and she came to me totally angry. So really seeking a fight and saying, what the hell is this company doing in our portfolio? I told you about British American Tobacco. Oh, no, I told you about tobacco stocks, I say, but it was British American Tobacco. Well, no, it was Philip Morris. I thought, okay, what the fuck? Anyway, I sold it straight away. I mean, this was not worth a fight. And I asked her, of course, the question about, okay, so where do you draw the line in ethical decisions? Well, that's also another learning, is never fight your wife, even if it's not in the circle of competence of her. Having said that, I think she has a lot of horse sense, so I learned to trust on her. I sold it straight away. And actually, when it comes to the question, any purchases, I don't know if realty income today, if it touched 59. If so, then I would have probably bought some realty income today in my portfolio.
Okay. A very wise decision to listen to your wife. Happy wife, happy life, as they say.
How about yourself? Did you buy something?
For me, no, I haven't bought anything for me yet. I have bought stuff for my son. He has his own money and he wanted to buy. And what's quite funny, actually, he came to me with a list of stocks at the start of the year. And he had Facebook, he had Neo, and he had this crowd called BNGOs, the ticker symbol. They're some biomechanical chemical company. And it was sitting there for a couple of days, and I didn't really look at it. And I went on to Twitter asking about the company. So eventually I looked it up. I sat him down, asked him about the company. He was able to answer all my questions without looking at it. And so he really did his research. I said, okay, let's get your money. And we transferred it over. While that transfer was happening, that price spiked over 100%. It just kills me, absolutely kills me. Yeah, he could have doubled his money, but we were waiting. So I transferred the money over on, I can't remember, on the Monday evening. It didn't get there till the Wednesday, but on the Tuesday, it spiked up.
Wow.
And on we use the gyro, and there's a question coming up on this soon. So I won't say it, but if it was on my account, I would have been able to actually buy it, but on the account that it's in, I had to wait until the money was there.
Wow. And did he buy it eventually?
He bought it. He bought it in the end. I asked him, I said, look, it's after popping twice now. And he said, I still think the company has a good future if they can deliver on what they're saying. So it popped up to $7. I went back down to $5, and we bought it at $5 from him. So we bought him some of that. But for me, I haven't bought that, but my son has been more active this year than I have.
Wow. It also increased the fair value of your son. I mean, imagine you could invest in your son, then he's also a bit worth more now if you would count his assets.
Yeah, I mean, I think he's going to retire before me, honestly.
Wow.
I don't even know how we picked this company, but hey.
Yeah, what guys do on YouTube nowadays. Okay, so the next question is from a Sego investor, and he is asking then if we have any thoughts on the Hero basic or custody account, opinion on lending shares.
I actually like, I call them the Gyro, but I like them a lot. They're my main broker, so I have three. I have the Gyro Trading 212 and IBRK, and I just can't get into IBRK. I just don't like the interface at all. They have a lot more options, obviously, but for me, the Gyro is cheaper, a lot cleaner to use, and easier to use. I have the active account, so you have a basic account, active and trading. So I have an active account, so that allows you to purchase options, for example, but it also gives you 50% margin. Like I was saying earlier, if it was on my account, I could have bought that while the money was transferring in, knowing that the money would go there. So on a basic account, you don't have that. But for me, I'm happy enough. I know there was some concern. For me, there was some concerns over the guarantee, how much money is guaranteed. But I know they've moved now to a German bank, FlatEx, so it's a little bit more safer than what it was. But I have no complaints. How about you?
Actually, similar story. I like the whole module and everything. What I just want to warn is that the Dutch Financial Authority has been really on the back of the Hero because of not living up to the quality level that they are expecting. So there's a report out on it, which makes me a bit nervous. But to my point, I still think because of flat tax and the banking license that we are fine as investors. But I do know that the company is being threatened with a penalty if they don't get their act together. So that also shows that the financial authorities are on their back, which keeps them a bit in check. And about the lending, I mean, this is with almost all those accounts done currently with Robinhood and everything. I think it's a bit the norm of today. We just haven't ever experienced a bank going down because of this. So
Yeah.
I don't know if this will be there in the future, and it's a risk, and it's the risk of having, and the reward is having low costs. Yeah, I don't know.
Yeah, and I know trading 212, you don't actually own the shares. I think that they own the actual shares, and they give you, I don't know, a certificate or something, but it's not. I think the shares are in their name, so it's this low fees. There's always something behind it. The low fees for a reason, and if you want to pay extra and have that safety, then you probably should.
So I will, let's say like that. I don't want my account on the Hero to be more than 100,000 euro. So that's where my limit is. So I also, like you, I diversify also in my brokerage accounts for if really something happens ever, at least I don't lose everything, but maybe a third or a fourth.
Yeah. Cool. Okay, so the next question then is from Arrows Detham. And he asked us, it's a very good question actually, he asked us, can you talk about how you estimate future growth of a company?
Yes. If you read my stock analysis, and I think it's the same with you, we always start with an understanding of the business. So if you see an article from me popping up about a company, like for instance Philips the other day, I don't write those in a day. I study the company usually for a few weeks, and we had a question from Phil also about it before, because I want to understand their business. What I do is I go to YouTube and check what people are telling about their products. As an example, I want to see if there's I said something going viral there, a trend, or whether they are complaining. So I really look at customer product reviews and such. And based on that, I start to form an opinion. I start to look at their strategy. I look at trends that I spot in the world. And based on that, I first judge, is this a company that is having the right products in the market, in the right market? So is it a good business? And only then I start to look at the financial details and make an estimate about the future EPS. I do look at analyst EPS and such to see what they are predicting, but I don't take too much out of it. It's more like for me sanity check if I'm way off or not.
Yeah, and just with them analysts, you'd normally get them on Yahoo or Morningstar, or sometimes I use Fast Graphs as well. So I have a similar story. I always see the growth drivers, what will actually drive that growth, and make an assessment of it. Like Walgreens, not many people agreed with me, but I thought online might be where the growth might come, and that seems to be the case in the UK. So always make your own assumption and then go look at the analysts and see if there's a mismatch, or if you're combined on what you think.
Yeah, true. Okay, so we have also a question from Kai, and he asks, with Joe Kaiser leaving, I'm very bullish for Siemens. Do you agree?
I don't think Joe Kaiser did a bad job. I don't know. I don't know enough about him, but I'm bullish on Siemens for their business. But for Joe Kaiser leaving, I'm not sure. I'm not so sure why that would be a bullish signal.
So I know a little bit about it. I think he became CEO in 2013, if I'm correctly. And I would like to just tell Kai, General Electric, I mean, it went through the toilet. Yeah, there's almost nothing back from it. Philips, it's now a medical tech company. Their legacy business, nothing. There was a reason they had to get out of it. Siemens, on the other hand, is one of those only few industrials that has been able to financially do well. Yeah. For me, the classical holding company in an industrial like General Electric is dead. The only company that is proving differently is Siemens. I think the CEO did a tremendous job with that during a decade where they could have easily failed like the other big ones. So for me, this CEO deserves a lot of credits for that. And I think he left the company after also the spin-off with Healthineers and such, I think it is. And then energy, I think he left a company behind, which the new CEO, I think he was a manager of operations, will be really grateful for, because he might then be known as the CEO that made the company grow really quickly. But I think the credits will actually go to Joe Kaiser to present it in this. That's my opinion, Kai.
Okay. And then the last question of the day is from Dividend Wave. He asked me personally on my thoughts on Walgreens, which I think I've answered at the start. And he also asked if you are adding any more shares of Johnson & Johnson.
Sure, on the dip.
Buy the dip.
Yeah, so it's good that he reminds me. I will put a purchase order in again at 135, just in case it ever gets there. So last year I had this luck, and J&J every year dips one time with 10-15%. So yeah. Thank you for reminding me, Dividend Wave. I know again what to put in my purchase orders.
Perfect. Thanks a million for all the questions again, guys. There were some good questions. As always, we enjoy answering all of them. So now it's my turn to sit back and relax, and it is your stock recommendation of this week, I think.
Yes. So I choose an insurance company. I did a post about this or a video about this not too long ago. And so why then also in Dividend Talk? Because I'm just... I noticed when I presented it, and I'm talking here about Nationale-Nederlanden Group, NN Group, this company is not too well known outside of the Netherlands. So that's why I wanted to bring it up. It's an insurance company. It is a spin-off of ING, a company that was really struggling during the financial crisis and is still struggling. I've been grown up in the Netherlands, and everyone knows Nationale-Nederlanden there. Also, when you go abroad in Europe, you see often on the buildings the big signs of Nationale-Nederlanden. So it's also, from that point of view, it has some branding. So when you think about NN Group, that's Nationale-Nederlanden. They were spun off, I think, 6 years ago. And since then, they have been really strong in their dividends, dividend growth. They have a cash flow payout ratio around, or EPS payout ratio around 50%. They've been growing their revenue from 14 billion in 2017 to 20 billion in 2020, which is a tremendous growth in revenue, I would say. And also their EPS has been growing nicely. It's not a straight line. It goes a bit up and down, but it's been growing nicely, and it's currently at around €4.5. And this is on the low end of the spectrum from the last few years. If you then look at their competition, right, their main competitors are Aegon, Achmea, and Allianz. And Allianz is the biggest and largest insurer probably in the whole world. I think they have few opportunities here. So first of all, they're in a steady business here, but they're really good in operational excellence. And I think every insurance company is currently looking at data science and customer insights and more tailored insurance. I think they will be able to pull it off, but I think like if everyone does it, then what's your edge? Yeah, and I think data science is overhyped. But they're actually also focused a lot on cost reduction. I think really, if you look at those companies, they still have a lot of fat on the bone in their processes. So ING is a master, for instance, in digitization with their banking app. I think Nationale-Nederlanden can definitely do something similar. If we then look at their dividend yield, it's around 6% at the moment. They have been growing the dividends around 8.5%. So if you look at the Chowder rule, we're almost talking about a 14.5 here, which is huge. I don't think they will be able to keep up the dividend growth like this. So I expect it to go a bit slower, but you get a fat dividend for it at the moment. At the same time, it's around a forward PE of less than 9. And this tells me just that there's still a lot of room in the share price. You need to know that analysts think that they have probably like still 10% undervalued. I think it's further undervalued. But I also know that analysts often take the former share price as a reference. And during the crisis, it dipped to the low 20s. It has been before in the 20s, but I think this is only under fear when it would go back into the 20s. In the normal circumstances, I think it's quite nice price now. The only thing that I have, and by the way, their debt to equity is around 30, so also strong balance sheet. The only reservation I have with this company is if you look at the return on equity versus the cost of capital, actually they earned less on their equity than the cost of capital. So it means they are not really generating shareholder wealth with their investments and equity at the moment. So this is a little bit what I want to see improve. here. Secondly, I think that in general, a part of the and mainly the customer interfacing part of the insurance industry might be threatened by fintech. So what you then get is actually that the traditional insurance companies maybe be more there for the large contracts and such. But I think there's an issue there maybe with their user experience that fintech companies can do better. And as always, with the trade wars, China, America, I don't know if we will see more protectionism. Specifically in Asia, this might take out the catalyst of Nationale Nederlanden potentially. But I see them as low risk, and I see the risk reward for a 6% yielder more on the reward side than on the risk side.
I have to say that I really like these one-sliders that you produce. I know you have it here, and literally has everything that you need to know about a company on one slide. One thing I do notice is that the free cash flow growth it's negative 400%. Is that right?
Yeah, but free cash flow is not the right how you say it metric for a company like insurance company. So I have it on there just for full disclosure and transparency, but I ignore this figure a bit because it makes no sense really for a company like NN Group to look too much at it.
Yeah, they look strong. The only concern I'd have is they have a very short dividend history, considering they're founded in the 60s. So they're still not proven. We don't know.
Because of the spin-off. That's because of the spin-off. Okay. And what I also want to say is, if you look up their dividend policy, they don't say a dividend growth policy, but they're really, really clear about shareholder return. That's one of their major focus areas. And I think it is. If you're a boring company like NN, what's else left there than to focus on your shareholders? So it's a Buffett-like company. I wouldn't be surprised if Buffett want to buy it one time.
Maybe send him an email. He might look him up.
Yeah.
Oh, it's great. It was a really nice pick, and I know you've done a video on it as well, so it's good to tie that in.
Cool. Means that we come to the end of the show again. It went really quick, but I love that we did some predictions on the dividends. I really enjoy such kind of things because it's really like the pub talk that I enjoy as well. So yeah, we should do this more often, I think. Let's see what the users think about it, if they enjoyed it just as much.
Exactly, and look, we'll see if we're right or wrong with our predictions. I'm usually wrong, so maybe the two that I said will increase. I'd say put your money on a decrease, but time will tell. But hey, look, that's the end of the show. Thanks to you again, and thanks to all the listeners for tuning in, and we shall see you all next week, hopefully.